Interest rates apply to interest-bearing assets, such as term deposits, and interest-bearing liabilities, such as lines of credit, bank bills, and bonds. They represent the price or point where supply of money meets demand for money, for varying maturities into the future. The willingness of a lender or borrower to participate in a transaction is based on their investment or funding needs and risk profiles, as well as their forecasts of interest rates and inflation. Interest rates are also useful as they represent the time value of money. That is, they are used to calculate the future value or present value of cash flows. Interest rates may be fixed or floating. A fixed rate locks in the applicable interest rate for the stated duration or term of the security. A floating rate or variable rate is a rate that moves in line with a particular reference rate, such as the bank bill swap reference rate, the London Interbank Offered Rate, or the Reserve Bank's target cash rate. The credit risk of the underlying security directly impacts the security's interest rate. For an Australian government bond, for example, there is little or no credit risk, and we refer to this interest rate as the risk-free rate. As the creditworthiness of an issuing organisation decreases, this has an inverse effect on the interest rate that is payable. So, the interest rate that applies to an unrated or high-risk organisation would include a credit risk premium on top of the risk-free rate. There are a number of different types of interest rates. Spot rates reflect the current interest rate for a particular financial instrument and maturity. For example, a 90-day bank bill rate of 4%, or a 10-year Treasury bond of 3.5%. Forward rates reflect the implicit rate at a future time, and they are based on the current interest rates that apply to set future periods. For example, a forward rate for a 1-year period starting in 3 years' time of 6.3%. Coupon rates reflect the coupon payable on a bond. If a bond does not have a coupon rate, it is referred to as a zero coupon bond. Swap rates represent the interest rates on swap transactions, which typically have durations of 1 to 10 years. For example, a 3-year fixed swap rate of 4.5%. Exposure to interest rates can lead to interest rate risk. Changes in interest rates can lead to higher or lower interest amounts payable or receivable. Even with fixed rate loans and investments, the fair value of the instrument can actually fluctuate if interest rates change. Further, changes in interest rates can have an impact on the demand for an organisation's products, as well as causing adjustments to contractual terms with customers or suppliers.